Hello everyone, this is Juan Sarmiento and today is Friday, June the 30th. I have here the IRA account and we're going to examine all of our covered calls and see what needs to be adjusted. Today is a Friday and therefore there is an expiration and we need to see whether we need to roll over, which means we buy back the short call we have and we sell one about 30 days from now, that expires about 30 days from now, or we simply let it expire. Okay, so those are the rollover or the let it expire and take with that our shares. Okay, I have organized them here by symbol and let's examine them one by one, starting with APA. And here's my trade, and you can see that I have this expiring on July the 14th, so no need to change any of that. We would want to see this getting closer to expiration, and if you need to look at the click on add simulated trades and you see your position here, that's your short, and then you look at the intrinsic and extrinsic value. If the intrinsic value is 0, that means that the option is out of the money, it could expire. And if the extrinsic value is 0 or below 0, it means we could be assigned, which means that the short being assigned, the shares are taken away. Okay, so in essence my position will be closed. This will happen for sure on expiration, but sometimes it happens 1, 2, or 3 days before expiration, and I don't mind that happening because it means that we had a profit. All right, so here in this case my option is 14 days to expiration, so I wouldn't have to do anything because as long as this extrinsic value has value in it, we expect that to go to 0, and therefore the value, the extrinsic value, we get to keep. Let's move on to coin, and here we have 7 days to expiration, which means we're talking about next week. And in this case, let's look at the I'm going to have to increase the number of strikes in order to see my position. Let's say 20, even more, 30, which means the stock has moved up very strongly. Okay, how about 40? That means a big move. I still don't see it. Okay, then 50. Not showing up. Oh, here it is. Okay, so the strike price is 50 and the stock is trading at 71. Okay. You can see that the extrinsic value is now negative or very close to 0, even though there are still 7 days to expiration. If this is 0, that means there is no point in staying with that any longer. So two things you can do is roll it and stay on the trade or let it close. I think we should examine the potential of rolling it, and we are going to go to 30 days from now, so presumably I would like to buy that. So I'm going to click on the ask to show that I'm buying it, and it will cost me $21.65. You'd say, well, that's a lot. Well, the option we're going to sell will reduce that value as well. So let's roll down to 30 days to expiration. 28 sounds good. And we look at the option with 0 intrinsic value. So we are getting $600 for that. See that? $6 for the extrinsic value. That means that if we were to sell this, we are going to get $600. All right. And the option we are buying back, there is practically no value to it. So you can do that the July for 28 days, July the 20th. What about the August the 4th, 35 days? Well, I tend to do that because there's more value there, $75. No, $750. See that? So we click on the bid, and that's how much we're getting. Okay, so do the math, and that will be 1435. That's money we are getting out. That means we are paying for this trade, for doing this roll up. And that's quite all right, because that means that that's money we got from the option value for the stock value. The stock increased from 50 to 70. Okay, so let's do that. I click here and say Analyze Rolling. And just change the date to August 4th and the price, the strike price, to 71. Okay, so it matches the one I just talked to you about. And the price should be about 14, I said. Okay, so 21 minus 7, 21.2 minus 7. Okay, 21.2 is the option. We are buying back, and we subtract the August 71 call option price, which is minus 7.05. That's 14.15. There is a bit of a bid and ask variation there. So you could put this to begin with, 14.15. Let's put 14 to begin with. That's a cost. So create duplicate order. And we would go for the mid 13, which is cheaper. Okay, that means I'm paying less because it's a debit. You see the debit, so it is less than I guesstimated 14.15. So yeah, let's confirm and send that, and then we adjust it as we go. Okay, and that will give us a cost, because we are paying for this $2,656. Okay, but let's examine that a little closer. Let's say, let's analyze that. Analyze trade. Okay, and we have our original trade. We can delete everything else, so leave our original trade and look at the risk graph. Okay, this is the original trade. Okay, and as you can see, that's not the real price. So let's go get that. Monitor tab and go back 30 days or more, let's say 40 days. And that was our original order, so that I can analyze that trade, and that gives me the original trade, and here it is. Okay, so how much am I getting? Well, that was very prolific, because with one trade we got $1,170, and I told you that if I get $500, I'm happy. So this is just for the one trade, because the volatility was so high. So if I do this rollover, how much would I get? Well, you need to go over here, and you can see that I get 2,700 with 2 months. So I say that's a great deal. Obviously, it's risky because it's a stock with high volatility, and the volatility, if the volatility collapses, great, but the stock can move strongly down as well as up. So you have to be aware of that. There's a risk involved. Just the same, I want to do it. Okay, so if this fills, then I could potentially do much more money. And so, because there's no point in waiting to my value is 0 when it's so close already, my extrinsic value is so close to 0, I'm not going to wait until the end. I'm going to do the rollover now, and that way I save money. I did it shorter time. Let's do that. Confirm and send. And it's going to cost us money, so we are adding to our cost. Okay, and we will see when it gets filled. You can go to the monitor tab over here, and it says what the margin requirement is and what the market value of the trade would be, and it's at $10,000, which is exactly what I wanted. Okay, let's do the same with the same trade with the let's create duplicate and send that to the margin account. You remember that I have this margin account running in parallel. Okay, this margin account running in parallel, same trade, same prices. Okay, so let's see if that gets filled. I will adjust if not. Let's move on to Etsy, and all I have to do here is hide all simulations so we can see where we are right here. And we already made a trade on this, I think. Yeah, we have two trades, so you can see the original trade and the rollover. But in any case, I'm not going to do anything with it. I'm just going to, yeah, let's copy it. Okay, so you adjust the price here to the date to July and the stock price, and then come over here and see that the original trade was 84.72, and we subtract the rollover. So the original price was 72. Okay, so we roll it over, meaning we bought the June call and we sold the July 21 call. You can see that clearly. So we subtract 420, so that our new price is $80.52, and we can put it here. And then you can see exactly how much money we had made after the two trades. With the one trade, it looks like we are with a little bit of a loser, but the truth is the first one was a winner, so we are here. Now in this case, you can see that the price has come down significantly. So we need to see what the price of the option we sold is right now, the extrinsic value of it. And here this is July, and let's look at the extrinsic value, and here it is, $1.76. So all of this is money that we are waiting to see that erode. The stock can go back up and land at 90 by the next expiration, so it's nothing we need to do right now. If this value was 0, I would consider rolling it up, rolling it down to a lower strike price, and that way get more extrinsic value. But no, that's not the case. We are waiting for this extrinsic value to erode more. Let's go to KSS. And here we see the risk graph. Let me delete that. That's my trade here. Yeah. Oh, I see that now that we're here. Let's go to the monitor tab and see what, yeah, that's the original trade. I haven't done any trading on that, any further trading. And it's July the 14th, and you can see that it's sitting here, so there is extrinsic value here. If it was down here or close to the pink and the magenta lines, where the magenta and the cyan lines were matched, that would mean that the extrinsic value is 0. So you would see quickly with the graph that there is extrinsic value. Confirm it here on that option, and yeah, I see 58 cents. So we are going to wait until that erodes. Let's move on to MOS and do the same thing. Go straight to the value of that option, and the extrinsic value is $1. So it's still eroding. If you want to see the risk graph, looks like we already did 2 trades on that. So here it is, okay? So same calculation. The same calculation is 34.33 minus 1.46. The new price is 32.87. We can analyze that. Change the strike price to 34.5 and the date to July 21st. We don't need to change anything. I just want to make a record of what we have. Okay, so we are here sitting, and you can see my profit is $489 with a potential, no, that's the potential is 489 from the original trade. Let's move on to a new. In this case, this is expiring today and it's below, you can see that it's below my break-even point, which means it's a loser. But we don't care about that. What we care is about recovering, getting that payoff of the covered call. So let's go to the monitor tab and we copy this, analyze trade, so you can see it. Okay. And so what do we do here? It's below the break-even point. It's a loser. So what do we do? Well, first of all, that option that we sold is probably close to zero in extrinsic value because it expires today. Right there. All right? Zero extrinsic value. So we can easily let that expire, and if we do that, we end up with 100 shares because this is out of the money. So we would end up with 100 shares and nothing else. You can come on Monday and then add your call, but the best approach is to buy this back and sell something new. Okay, so analyze rolling. Here it is. Okay, if I were to sell the August 4th, I will get 87 cents. But let's see if that is the best option we can sell. Well, no. Remember, our approach is to sell the option that is with the maximum extrinsic value and the minimum intrinsic value. So this one will be the 64, and 64 is actually above the current price, but not as high as 69, which was the original. Okay, so the stock has gone down, and instead of thinking, oh, we lost money, no, what we're thinking is, what do I sell to get more in extrinsic value? So I'm gonna sell the 84 to get more of that value, 84, okay? And you can see that I'm getting $240, and you say, well, that's not that much. You could have gotten more. All right, so this, and in fact, if we are successful and the stock closes above the strike price, we're not going to get much money out of that. This thing is not showing me what should be showing me, which is the additional. But you can see that it will come here only if it goes all the way up here. It would be positive if it comes and it would just simply recover in, but the point is the stocks go up and down, but what remains constant is that we are getting money from the rollover. Okay, so I'm not getting a whole lot, but I'm trying to recover. You can say, well, that's a loser. I'd rather close at $148 loss. There's not much value on that option that I'm selling the August. It's only $237. Okay, so I'm gonna do it for demonstration purposes. Okay, you might say, well, let's just close that position, take our loss, which is only $100 and some odd dollars. Okay, or you can say, well, let's examine what are we doing here when we buy the 69 call and sell the 64 call at a later date, because the option, this August option, is only $237. See that? Okay, so we are paying 1 penny for the option we're closing, and we're getting $236 for the option we're buying. So we're selling. The option we're buying, we're paying 1 penny. Okay, create duplicate order. And again, I'm doing this for demonstration purposes. In real life, I'd probably close it, not happy with it. But let's say confirm and send multiple accounts, and we do the same for both accounts. Okay? And why is this? Well, because there was an earnings report and the option dropped in value. Okay, so you can expect an option to drop in value when earnings come, because volatility will decline. Okay, nonetheless, we're going to just do it the rollover and learn from this experience. Okay, let's move on to Roku. And let's see the risk profile, and this is expiring today as well. Let's go to the IRA account, and we're going to do a rollover on this one. In this case, look here, it's up here at 64, when my option was 57, so the stock has gone up. If you didn't do anything today, it would simply be taken away, because this call has value in it. Let's look at the position here, go to the chart, and you can see that the extrinsic value is actually negative. Okay, so it has mostly intrinsic value, and so that means that it will be taken away. Okay, so what if we did the rollover? If we did the rollover, same expiration, but a month from now, so August 4th, 262. Okay, let's look at it. $262. August 4th. Yeah, the option has declined. The option value has declined a lot. And we're going to the 57 here. Okay, so in this case, we're going to look for the same expiration, but we're going to look for the best extrinsic value here. Right here, the 64 is going to give us $537, and then, okay, I told you before, if you get $500, you should be happy. Okay, we don't concern ourselves with the intrinsic value of 79 or 0 or whatever in the stock value, because the stock value, we have it locked in. It goes up and down. It doesn't matter. What matters is the option cost that we are recovering. So I'm going to go here and I'm going to sell the 64. Okay, and I'm paying, but you might say I'm getting the profit that I got from the stock going up and using it to pay for this trade, which is to pay back for this June option that has gained so much value. But look at it from this perspective. Hide the simulation. You can see here that we have $418 accumulated. If we do this trade, we will get a potential. Unfortunately, I can't tell you that, but here a potential of $543. It's not showing because it's open here. Let's get the original. That's not right. Here it is. Okay, so let's show the original analyzed trade. This is the original, and $418 profit. If we add the trade as I told you now, we could get $967, okay, in 2 months. Okay, so that's close to $500 on each trade. That sounds great. That's the maximum. If the stock really closes on August 4th at or above the current the strike price of 64. Okay, I'm happy with that. So let's say create duplicate order, confirm and send to both accounts. Okay, and as you can see, it's a diagonal spread really, and it's negative because it's a debit when it should have been a credit. Okay, let's send that off. confirm that that's okay. Did it? Okay. So let's copy that. So Roku got done. The others having trouble. The other two, but we'll come back to them. Okay. 145 was my debit in the end. And this is what the trade looks like now. We adjusted at August 64. And we take this price and subtract an increase by 145 because it's a debit. So 52.82 plus 1.45. So our cost has increased. Okay. And this is what it would look like, and our maximum will be 973 maximum profit if it stays at this price or goes. But all we care about is the option being eroded. Okay, let's move on to SPRWR. In this case, this has been really negative because it's moved significantly from my strike price of 11.50. So this one expires on July the 14th, but now there is practically no extrinsic value on that one. Again, yeah, we've lost in the value of the stock, but that could come up anytime. We don't know when that's going to happen, but the assumption is that eventually it will balance out. For now, we just make sure that we collect our value. So you can see the extrinsic value is 0.03. So I'm going to buy that back. Let me copy my trade here first. Okay, so what do we do here? This is what it looks like. So we would use the strike price of 9.5 and the expiration. So let me just show it. Analyze rolling. And we're going to look for the option with the most value that expires, most extrinsic value that expires on August 14th. And that's 9.5, and that will be 81 cents. So I'm going to roll it to August 4th, and instead of 11.5, I say 9.5. So it may look like I'm trying to say salvage a trade that has gone bad, because if it goes back up, I'm not going to recover all the money. But in reality, this stock will go up or down. It doesn't matter. I'm still collecting that extrinsic value, which is in this case 77 cents. Okay. Let's look at it from this perspective. We go over here and we see that we get 60 cents. Well, 60 cents for each option, and I have 9 options, so 9.60 times 9 times 100, $540. And I told you that's perfect. That's more than $500 that I want. So I'm still recovering those $500. Okay, I'm not losing. I'm losing in the value of the stock, but I'm not losing in the option game. I'm still recovering. And a year from now, we might be able to recover the entire value of the stock in option selling. That's the purpose. Okay. All right. So 79 sounds great. We can put even 80, but I'm going to stick with 79. Confirm and send. And I'm going to say multiple. And we're going to do 9 on each. Send. let's go to WDC. And go to the IRA account. This stock has gone from 40 to 38, still value. Let's go look for the monitor tab and go back 60 days, because this is, I think it's the second month on it. Yes. So you see 3.43 minus 2.1. Okay. So again, the original price was 34.43. The rollover gave us a debit, so we have to add the value of the debit, which was 2.1. Okay, so the value of my trade is larger now. It doesn't matter because we are counting here. What we are counting is, because I did a roll up from 36 to 40, see? I had to pay for that roll up. And July 7th is my expiration. So just paste that number, and here it is. That's my current trade, and even though it has come down, we're still here. We have made now is the SPWR field. Good. Okay, so here we are at $374 overall profit, but we are collecting that money, that option money. So yeah, the stock has gone up and then down and then presumably will go up. It doesn't matter to us. What matters is we are collecting that extrinsic value. Okay, all right, so 40. So we have $350 profit so far. And when does this expire? Next week. So we don't need to change anything unless the option that we are holding, the short option, had 0 extrinsic value. No, it has 51. So we are going to wait that. For all we know, the stock will move back up to 40 and then give me my maximum profit of $1,041. Right now it looks like we're losing, but that changes, okay? All right, let's move on to X. And in this case, also expiring today, the stock is trading at 24 and my option 21 call expires today. Okay, so let's come over here, 21, and is negative. Okay, so we need to close this because otherwise my stock will be taken away. You may have the option to, okay, I'm tired of this X, I don't think it's going to do well or whatever, and you say, I'm letting it go. Yes, you could let it go, or you can do what I'm going to do now. Copy that. I'm going to look for the option that expires on August the 4th. 35 days from now, you can say the 28th, that's fine too, okay? And with a maximum extrinsic value, that's 1.195, say. So in this case, you take the 1.195 extrinsic value, we get to keep that, okay? And the stock is trading at 91.5. So multiply that times 500, and that's almost $600 by doing that. Yes, we're going to pay some to roll it up to 21, but we get to keep $600, $597, and that to me is a great deal. Okay? We say, on average, assuming that your option is about total is about $10,000, you're getting $500, great, right? You may have the calculation, you may do the calculations that I do, okay? You take the stock price and the option price and the multiplier, how many times you have to, in this case 5 times. Okay, so let's do this. I put X here to make sure, to figure out if the option is worth selling. 24.785. Then what is the ATM at the money call, and I just told you what the price was, $1, $1.95. Okay, and we're going to do 5. That's our multiplier. We're multiplying times 5, so it approaches 500, 10,000, which is 10% of our account. In the case of the IRA account, in the case of the margin account, it will be 20%. Okay, so here we are, and we multiply times 5. Okay, and that gives us, my maximum profit will be $597. But how much would that be if my account, if this trade was actually $100? Okay, because then it will be $100, 10% of your account, you have one call. Yeah, this will be the price, actually a little below 500, so it's still pretty good though. Okay, so I'm happy with that, so let's do that. So I'm simply going to say analyze rolling, and I'm going to put here August 4th, and we're going to do, what option did we say? 25 call. Okay, so that's how it's done. You've seen me rolling down, rolling up, leaving it alone, and hopefully making money. Okay, so here, that's what I want to do. Even though we are paying, we are getting that extrinsic value which we want. We are paying, but in reality we are covering the stock. The stock goes up and down, and when the stock goes down, we actually get credit. When the stock goes up, we actually pay. Okay, so that doesn't matter. What matters is the extrinsic value of the option that I'm selling. Okay, all right. So I create duplicate order, confirm and send, multiple, and we're gonna do 5 in each account. Okay, and that got filled immediately, so we can confirm that. Actually here, X, let's copy that, and then we adjust our trade. Right now, let's go to the IRA account. So my original price was $19.69, so we're gonna add the 260. Analyze trade, change the option to August 4th, strike price 25. And my price is 19.69 plus 2.6, 22.29. And that's my trade now. We hide the position and delete, and we just stick with the adjusted trade so you can see exactly where we are and how much money I'm expected to make. And here I have made already $656. You see the number here? As I put my cursor right at the current price, you see that I have made $655, or you can see it here, P&L since the opening. And what am I expected to make? Over here, the magenta color is $13.55. Okay, if everything goes according to plan, we would make money, additional money, and every month we make $500 per trade, and that's hopefully, okay? I'm not saying it's going to happen all the time, but that's what you want to do. Let's go to the account statement, and we can see that year to date we have made $4,254, and we've been doing this for a little over a month. Okay, so that's not too bad, is it? Okay, considering that you would make 4%, 5% on a CD, this is a way to make money consistently, as consistent as you can be when it comes to trading options. On the IRA, on the margin account, my value is much more increased. It's a larger percent because we are making the exact same amount of money with half the investment. Of course, there is risk to doing margin account, because if the value drops on the stock market in general, you may get margin call and then you have to come up with additional money. Okay, so presumably you have money on CDs that you could release to pay for a margin call, but I don't anticipate that. And if it ever happened that one stock goes too much and you get a margin call for a call, that means you need to close some positions. Here's your margin. You see the margin requirement, and we do have that much money in our account. All right. Market value is $90,000. What about my IRA? In my IRA, I could still do one more trade because we have $13,000. We can potentially do one. I just as soon let it be there to protect me. Okay? Leave this here to protect you in case you know, as you can see, you need to buy. If you need to roll up some things, you need to have some cash in hand. Okay, that's all for today. Thank you very much for joining me, and see you next time. Bye-bye.